So why is it that I trade options rather than trading stocks or forex or futures? Well, primarily I trade options because I don't have a crystal ball. I can't predict anything. I can't predict whether that next candlestick is going to be a green candle or a red candle. I can't do that. As a matter of fact, not only can I not do that, I don't think any of you can do it either, even though a lot of you guys are trying to live that quote day trading dream where you think you can predict the market and you can call the next candle. You can call it whether it's going to be a red candle or a green candle, but I think you're lying to yourself. I think you're kidding yourself. For me, I'm just straight up honest with myself. I know I don't have a crystal ball. My crystal ball's broken, right? I can't predict shit when it comes to direction. So I trade options because options means I don't have to predict direction. I don't have to guess a direction and I don't have to be right on that direction to make money. So let me switch over to my trading platform. So I typically make somewhere around 2,500 to 3,000 options trades every year. That's about my average. It's about 2,500 options trades every year. I've done that for the last several years. So thousands and thousands of options trades. And these are some of the most common strategies that I use. And none of these strategies require me to guess a direction and be right in order to make money. So I'm going to go to Apple. Let's go to the options chain for Apple. One of the most common trades, maybe the most common trade I put on is the short put. Just a naked short put. Typically, I'll sell a put somewhere between 10 and 20 deltas. In this case, let's say I sell the 18 delta put. I received a $249 credit on a buying power reduction of $2,300. This is a normal trade for me, and let's take a look at the risk profile of a short put. You can see this is where Apple is currently trading. This is where my put is. So Apple, if it goes up, I obviously make money. If it goes down, I make money as long as it doesn't go below my put, right? And actually, it can go a little bit below my put as long as it doesn't go below the break even, which is the credit received, which is the $249. So I have $2.49 of runway to the downside, but after that, I start losing. And it could be a potentially huge loss because there is undefined risk on a short put all the way to zero should that happen. But this is a very high probability trade. That 18 delta put, I have a probability of profit on this trade of 83%. So 83% of the time, if I hold this to expiration, I will make money. You can see the P50 number, the probability that I make at least 50% max profit at some point during the life of this trade is at 93%. So if I put on a 50% take profit order, 93% of the time, that will get triggered. That is huge, right? That is a very big win rate. And it doesn't matter. Again, the stock goes up, I obviously win. If the stock stays still, I obviously win. But if it goes down, as long as it doesn't go down in a big way, I also win. Probably the next most common trade that I put on is a strangle. So, for me, I typically go like one standard deviation for a strangle. In this example, let's go to the 14 delta put and the 13 delta call. In this case, I'll receive a 316 credit on a buying power reduction of $2,100. And a strangle, obviously, I don't have to guess direction. A strangle is basically I'm picking a range. As long as the stock stays within that range, I'm going to win, right? So a strangle is perfect. I don't care if the stock goes up, as long as it just doesn't go up too much. I don't care if it goes down, as long as it doesn't go down too much. Ideally, I'd like it to kind of hang out where it's at. It's going to go up and down a little bit over the life of this trade. You're not going to have a stock just stay still. It will move around a little bit, but chances are, 76% of the time, it's going to land in this range by expiration, and I'm going to win on the trade. And just like the short put, the P50 percentage is extremely high on this one standard deviation strangle, 93% on this strangle, right? So that, again, that's a very, very high win rate on a strategy where I don't really have to predict a direction. Now, if you've got a smaller account and you can't sell a naked strangle on a product like Apple, you can always do defined risk trades. Like you can turn this into an iron condor. Let me move these in a little bit. This would be like a standard kind of iron condor that I would trade where I'm risking about $360 to make about $140, and very similar to the risk profile on the strangle. As long as it stays within the range, you win, but we've defined our risk to the downside and to the upside by buying these long wings that form the iron condor, where the Strangle, of course, had undefined risk to each side. Another kind of common strategy that you'll see a lot of people use is the Jade Lizard. What is the Jade Lizard? Well, a lot of people don't really fear the downside of a Strangle, so they'll do the naked put, right? But they kind of fear the upside with the call, so what they'll do is they'll define their risk just on the call side of a Strangle. And this is known as a Jade Lizard, where you've still got the undefined risk on the put, but you've capped your upside risk. Typically on these Jade Lizards, you'll bring the call credit spread side of this in a little bit, hopefully to the point where you can't really lose to the upside. So this is kind of a standard kind of Jade Lizard, where as long as the stock doesn't move much in either direction, you make a nice little profit. But if it moves way up, then you're basically going to win a very tiny amount, but you can't lose at least. But the real risk, of course, would be on the put side. But if, for example, you are running the wheel and you don't mind taking assignment, the Jade Lizard is a nice way to start the wheel. Some other very common strategies that I use all the time, one of my most common trades are credit spreads, both put credit spreads and call credit spreads. This is an example of a put credit spread. I'm risking $370 to make $130, and even though it is a bullish trade, ideally I would like the stock to go up from here. I do have a little bit of runway to the downside, right? I don't necessarily have to have this thing go up. It can go down a little bit as long as it doesn't move in a big way. So again, I've got a little bit of wiggle room where even though the put credit spread, yes, I'm guessing that the stock is going to go up, but I don't necessarily have to get that right in order to make money. And the same is true on the other end of the trade with the call credit spread. I don't necessarily have to have this thing move down. Ideally, I want it to go down because I'm betting, I'm being bearish here in directional assumption, but as long as it goes up, just not too much, I'm still okay. And these put credit spreads and call credit spread trades, these also have a very high probability of profit because we get to be out of the money when we sell these spreads. In this case, this call credit spread, I have a pop of nearly 70%. I have a P50 of 80%. So these, again, are really high probability trades. I'm much more likely to win on these trades than lose on these trades, and I don't necessarily have to be right on direction. One of my favorite trades is actually the ratio spread. The ratio spread is where I buy a put debit spread. Let's do a put ratio spread. I buy a put debit spread as a downside play, right, as a bearish trade, but then I double up the short put, which is a bullish play, right? So I've kind of put on two trades at the same time. I've got a put debit spread that's a bearish play, plus an additional naked short put, which is a bullish play, and it makes this really odd looking risk profile, right? So you've got this risk profile here with the hump here toward the downside. So this is where Apple is trading, and if Apple slowly moves down, I could make a nice little chunk of change if it finishes inside the spread here. And that's typically not what you want. Typically, you want Apple to either move up, stay still, or move down, but just a little, and you just settle for this smaller profit area. But this additional put debit spread that's part of the ratio spread, it's kind of a hedge. So it's kind of there for an emergency situation where if it really makes a big move against you, well, at least you had the put debit spread there as a little bit of a hedge to give you a little more runway to the downside, you know, for a bigger break-even point here before you really start losing. So that's the put ratio spread. It's basically where, hey, I want to sell a naked put on something, but I'm a little concerned. Well, if you're a little concerned with selling a naked short put, put on a put ratio spread instead. And you can, of course, do the same on the call side. For example, I buy a call debit spread and then double up the short call. This would be the call ratio spread. Again, ideally, I want the stock to go down. It's a bearish play, but if the stock goes up, I'm not necessarily in that much trouble unless it makes a huge move up against me. And then, of course, I would be in a lot of trouble because the one additional naked short call has unlimited risk, obviously, to the upside. So those are, I don't know, 7 or 8 common trades that I put on all the time. If I take a look at my portfolio right now, I mean, I have, well, there's a ratio spread. There's a ratio spread. Here's a strangle. Here's a strangle. Here's a naked short put. Here's a strangle, a ratioed strangle, 2 puts versus 1 call. Here is a put credit spread. Here is a strangle. Here is a put credit spread. Here is a strangle. Here is a put credit spread. Here's a naked short put. Here is a put credit spread. Here is a strangle, and here is a strangle. So these are the trades that I put on, right? And why do I use these strategies? It's because, again, I don't have a crystal ball. And honestly, you don't have a crystal ball either. If you're one of these people that are trying to make that whole day trading scam work, you've been lied to. You've bought into some of the bullshit from the fake trading gurus that are on YouTube and TikTok. Those guys that are telling you you can go scalp forex and scalp futures and actually make a consistent profit from it. You can't. That's bullshit, right? I'm just telling you now, that is not what real traders are doing. That's not where the smart traders are putting their effort, right? You know, the smart traders are actually trading options. That's where you need to be. You need to discover the wonderful world of options trading before it's too late. Peace, guys.